I want you to look me in the eye right now. Look at this camera, because what I'm about to tell you will make you sick. I got a letter last week, not an email. A physical letter forwarded to me by a woman named Diane Kowalski from a suburb outside Columbus, Ohio. Diane is 74. She taught third grade for 31 years. Her husband Gary worked at a Honda distribution center for 28. They did everything right. Packed lunches, drove used Toyotas while the neighbors leased BMWs, maxed out their 403b and traditional IRA every year like clockwork. When Gary retired at 62, they had $2 million in combined traditional IRAs. For a decade, they lived on about $40,000 a year from those IRAs plus Social Security and refused to touch the principal. Diane wrote me one line that I want to burn into your brain. Then, the IRS came for their share. When Gary turned 73, the IRS forced him and Diane to withdraw over $143,000 from their traditional IRA in a single year. Not because they wanted to, not because they needed the money, because a law called the Secure Act II, codified under IRC Section 401A9, required it. That is what a required minimum distribution is. The IRS does not care that you are frugal. The IRS does not care that you are careful. The IRS does not care that you spent your entire adult life being responsible. What the IRS cares about is that you have been deferring taxes for decades and the bill has come due. Diane and Gary's forced withdrawal of $143,000 stacked on top of their combined Social Security benefits and a small amount of dividend income from a brokerage account Gary had kept since the 90s pushed their combined adjusted gross income to $222,000. Read that number again. $222,000. For a retired school teacher and a warehouse logistics manager who were voluntarily living on $40,000 a year, that number shoved them past the income-related monthly adjustment amount threshold for Medicare Part B, which in 2026 is $218,000 for married couples filing jointly. The standard Medicare Part B premium this year is $202.90 per month. But because of that RMD trigger, Diane and Gary each got hit with an $81.20 monthly surcharge, plus a Part D prescription drug surcharge on top. That is an additional $1,949 a year in Medicare penalties alone for a couple who was trying to save money by not spending it. And here is the part that makes me want to flip a table. That IRMA surcharge is calculated on a 2-year look-back. So the damage Gary and Diane did to themselves by letting that IRA balloon did not just hit them at 73, it rippled forward. Every single year that the RMD pushes their income above $218,000, they pay the surcharge. They cannot escape it. They built their own prison out of frugality and compound interest, and the IRS locked the door behind them. This is what I call the frugality tax bomb. And if you are sitting on a portfolio north of $2 million and you are terrified to spend your own money, you are building the same bomb right now, and you do not even know it. Let me back up and explain the mechanics of this trap, because every gear matters. When you contribute to a traditional IRA or 401k, you get a tax deduction that year. That is the bait. The IRS says, defer the taxes now, pay us later. You think you will be in a lower bracket in retirement, but the IRS is not giving you a gift. The IRS is giving you a loan that compounds against you. Every dollar of growth, every dividend reinvested, every gain inside that account, all of it is taxed as ordinary income when it comes out. Not capital gains rates, ordinary income, and the IRS has set a timer. Under the Secure Act II, if you were born between 1951 and 1959, you must begin required minimum distributions in the year you turn 73. Miss the deadline and the penalty is 25% of the amount you failed to withdraw, reduced to 10% only if corrected within 2 years under the Secure II correction window. Now, let me show you the math that Diane and Gary's financial advisor never showed them. At age 62, $2 million, annual withdrawals of $40,000, market growth of roughly 7 and 2% in a historic bull run. Year 1, the balance after withdrawal grows to $2,107,000. Year 3, $2,341,000. Year 7, $2,840,000. By the time Gary turned 73, 11 years later, their combined traditional IRA balance had grown to approximately $3,800,000. They started with $2 million, withdrew over $440,000 across a decade, and the account was still 85% larger. Compound interest made them rich on paper and bankrupt in tax efficiency. Their first required minimum distribution was calculated using the IRS Uniform Lifetime Table published in Publication 590B, Appendix B, Table 3. At age 73, the life expectancy divisor is 26.5. Take $3,800,000 and divide by 26.5. That equals 143,396. That is not a withdrawal they chose. That is a withdrawal the IRS chose for them. It is forced taxable income. Every penny of it is taxed at ordinary income rates. Now, Stack that on top of their Social Security. Gary and Diane collect $48,000 combined. But here's the next trap inside the trap. Social Security taxation is based on combined income. Your AGI plus tax-exempt interest plus half your Social Security benefits, compared to thresholds that have not been adjusted since 1984. For married filing jointly, above $32,000 up to 50% is taxable, above $44,000 up to 85%. Diane and Gary's combined income is not in the same zip code as $44,000. Their RMD alone is $143,000. Add half their Social Security and their dividend income, and their combined income is over $182,000. 85% of their Social Security is taxable. That adds almost $800 to their AGI. The money the government promised as a retirement safety net is now being taxed because the government forced them to withdraw from an account the government told them to save in. If that does not make you furious, you are not paying attention. The suits want me to tell you this is not financial advice. Fine, it is not financial advice. It is a survival manual for an unguarded vault. If you still trust the people who designed a tax code that punishes you for being too responsible with your own money, by all means consult them. But bring a calculator, because they are going to need one when you show them what I am about to show you. Let me walk you through the full tax calculation for Diane and Gary in 2026. Under Scenario A, the fear scenario, the scenario where they refuse to spend their own money. Their adjusted gross income is $143,396 from the RMD, plus $40,800 in taxable Social Security, plus $15,000 in dividends and interest. Total AGI $196. Now apply the deductions. Under the One Big Beautiful Bill Act, signed on July 4th, 2025, the standard deduction for married filing jointly in 2026 is $32,200. Both Diane and Gary are over 65, so they each qualify for the additional standard deduction of $1,750, adding $3,300 to the base. And here is a wrinkle almost nobody knows about. The OBBBA created a brand new temporary senior bonus deduction of $6,000 per qualifying taxpayer age 65 or older. That is $12,000 for a married couple, but it phases out at a rate of 6% of modified adjusted gross income above $150,000 for joint filers. Diane and Gary's AGI is $199,196. The excess above $150,000 is $49,196. Multiply that by 6%. That is $2,950 in phase out. Their senior bonus deduction is reduced from $12,000 to $948. Total deductions, $32,200 plus $3,300 plus $948, $44,148. Taxable income, $199,196. $44,548. $454,648. Now apply the 2026 tax brackets from revenue procedure between 25-32. 10% on the first $24,800 to now $280. 12% on income from $24,801 to $100,800, $9,120. 22% of income from $100,801 to $154,648. $648. That's $5,848. Times 22% equals $11,847. Total federal income tax, $23,447. But we are not done. If Diane and Gary live in Ohio, the Ohio income tax adds approximately $4,200 on top of that at their income level under the current Ohio revised code rate structure. If they live in California, the Franchise Tax Board would extract roughly $8,000 to $9,000. If they live in Florida, they pay zero state income tax on the RMD, which is one of the reasons half the retirees in America are staring at Zillow listings in Naples right now. Let me show you what that looks like across those three states. Florida, federal tax zero. Medicare RMD surcharge. Let us assume their total Magi state is just under the $218,000 threshold because they are in Florida with no state tax deduction shenanigans. So zero RMD. Total annual tax burden approximately $23,440. Ohio, federal tax $23,447. Ohio state income tax approximately $4,200. IRMA. If their brokerage account kicks out a slightly higher dividend year and pushes them past $218,000, the couple pays $1,949 per year in Part B surcharges alone. Total annual tax burden, approximately $29,596. California, federal tax $23,447. California state income tax approximately $8,700. And in California, with higher costs and potentially higher income from additional sources to cover those costs, IRMA is almost certainly triggered. Add the $1,249 total annual tax burden, approximately $35,096. I want you to stop and absorb those numbers. A retired school teacher and a warehouse worker are paying between $23,000 and $34,000 in combined taxes in a single year because they were too afraid to spend their own money in their 60s. That is not a mistake. That is a designed outcome. The tax code rewarded them for saving, then it punished them for succeeding, and it gets worse. The IRA does not stop growing just because RMDs started. The divisor drops every year. At 75, 24.6. At 80, 20.2. At 85, 16. At 90, 12.2. Even as the account slowly shrinks, the percentage pulled out accelerates. The IRS carves the turkey faster the older you get, and every slice is taxed at ordinary income rates, pushes more Social Security into the taxable column, risks triggering higher RMD tiers, and erodes the money you thought would be there for your children. Now, I need to talk about the villain. And the villain is not a person. The villain is a psychological trap weaponized by the tax code. The Secure Act 2, part of the Consolidated Appropriations Act of 2023, changed the RMD age from 72 to 73 for people born between 1951 and 1959. It changes again to 75 for those born in 1960 or later. But that delay was not a gift. That delay was a fuse extension. By pushing the RMD age back 1 year, Congress gave your traditional IRA 1 more year to compound, 1 more year to grow, 1 more year to build up the balance. The IRS will eventually force you to withdraw. They did not reduce your tax burden, they increased it. They made the bomb bigger, and this is where the Social Security torpedo goes nuclear. The combined income thresholds, $32,000 and $44,000 for joint filers, were set in 1984, never adjusted for inflation. In 1984, $44,000 were meaningful. In 2026, it is a rounding error. Nearly every retiree who takes an RMD of any meaningful size will have 85% of their benefits taxed. And in the income zone between those two thresholds, every additional dollar can cause up to 85 cents of extra Social Security to become taxable, spiking your effective marginal rate above 40%, even if your nominal bracket is 12 or 22%. Let me show you what this looks like across the country. Take a couple in Ohio with $3,000 and $800,000 in a traditional IRA at 73, RMD of $143,000. Combined with Social Security, dividend income, and 85% of benefits being taxable, their AGI pushes well past the IRMA threshold. Ohio layers on its own state income tax. Take that same couple in California, where the Franchise Tax Board charges $8,000 to $9,000 on top of federal, or Florida, where there is no state income tax, but the federal bill and IRMA surcharges still devastate. The geography changes, the principle does not. Every one of these couples is penalized for saving too much and spending too little. Let me now talk about the SHIELD strategic drawdown. Not complicated, not risky, just arithmetic. Instead of letting your traditional IRA compound into a monster the IRS will harvest, you deliberately draw it down during your 60s at the lowest possible tax rates on your terms. Richard and Susan, our counterpoint couple, also retired at 62 with $2 million in traditional IRAs, but they sat down with a tax-aware planner and mapped a decade-long drawdown strategy. They withdraw $100,000 per year to live on. They take vacations, remodel the kitchen, and visit their grandchildren. On top of that spending, they execute Roth conversions of $50,000 per year. Their total annual IRA reduction is $150,000. Their taxable IRA income each year is $150,000. If they delay Social Security to maximize benefits, their only income is the IRA withdrawal. After deductions of $4,750, including the standard deduction of $32,200, the senior addition of $3,300, and the full ABBA senior bonus of $12,000 because their MAGI is under $150,000, their taxable income is approximately $102,500. The tax on that in 2026 is about $12,860, an effective federal rate of 8.6% on $150,000 in gross distributions. Compare that to Diane and Gary paying $23,447 on a forced withdrawal they did not want. Richard and Susan pay 53% less in federal tax, and they get to enjoy their money. But the real magic is what happens at age 73. Because Richard and Susan withdrew $150,000 per year from their traditional IRAs for 11 years, their IRA balance did not balloon to $3,800,000. Even with 7.5% market growth, the IRA was being drained faster than it was growing. By the time they hit 73, their combined traditional IRA balance is approximately $1,400,000. The RMD on $1,400,000 at a divisor of 26.5 is $52,830. $52,130. Compare that to Diane and Gary's forced RMD of $140,396. Richard and Susan's RMD is 63% smaller. Let me now walk you through Richard and Susan's tax situation at age 73. Their RMD is $52,830. They are now collecting Social Security, let us say $48,000 combined. Their combined income for Social Security taxation purposes is $52,830 plus $15,000 in investment income plus $24,000, which is half their Social Security. That is $91,830. 85% of their benefits are still taxable because the threshold is absurdly low. So, at $4,800, their AGI is $52,830 plus $40,800 plus $15,000 equals $108,630. Deductions: standard deduction $32,200, senior additional $3,300. OBIBA senior bonus a full $12,000 because their MAGI of $108,630 is below the $150,000 phase out threshold. Total deductions $47,500. Taxable income $108,630 minus $45,500 equals $61,130. Tax on $61,130 in the 2026 brackets. 10% on $24,800 equals $2,480. 12% on $36,330 from $24,801 to $61,130 equals $43,660. Total federal income tax $6,140. Let that number sit with you. $6,140. Diane and Gary are paying $23,147. Richard and Susan are paying $6,840. That is a difference of $16,607 per year, every single year, for the rest of their lives. Over 15 years of retirement, that is nearly $250,000 in cumulative tax savings. And that does not even account for the RMD surcharges that Diane and Gary are paying and Richard and Susan are not, the state income tax difference in states like Ohio and California, or the fact that Richard and Susan have a Roth IRA worth over $700,000 from their conversions growing completely tax-free, which they never have to take RMDs from, and which their heirs can inherit tax-free. And here's the beautiful irony. Richard and Susan spent more money in their 60s. They lived better, they traveled, they ate at restaurants, they did the things Diane and Gary refused to do. And they ended up with a lower tax burden, a higher after-tax net worth, and more money for their children. Frugality was not the winning strategy. Tax-aware spending was. Now, let me give you the action plan. Not theory, not generalities, a step-by-step checklist of what you need to do starting today to defuse the bomb before the IRS detonates it for you. Step 1. Pull every IRA statement you have and calculate your total traditional IRA balance across all accounts. Traditional IRA, 401k, 403b, 457, SEP, simple, every tax-deferred account you own. That number is the fuse. Step 2. Go to IRS, publication 590B, Appendix B, Table 3. The divisor at 73 is 26.5. Project your balance forward at 5, 6, and 7% growth to age 73. Divide each projected balance by 26.5. Those numbers are your future forced income. If any of those projected RMDs, stacked on Social Security and other income, push your MAGI above $109,000 as a single filer or $218,000 married filing jointly, you will trigger IRMA. Every dollar above those thresholds costs you for at least 2 years because of the look back. Step 3, calculate your available tax base. This is the most important number in retirement tax planning. The top of the 12% bracket for married filing jointly in 2026 is $100, $800 in taxable income. Add your deductions back. Standard deduction, $32,200. Senior deduction, $3,300. Senior bonus, up to $12,000. Your gross income ceiling to stay in the 12% bracket is approximately $148,300. If your current income is below that, the gap is your Roth conversion space. Every dollar you convert at 12% today is a dollar the IRS cannot tax at 22% or higher at 73. Step 4, execute annual Roth conversions up to the top of the 12% bracket. If you have room and risk tolerance, fill into the 22% bracket, which tops at $200 and limit to $400 for married filing jointly. The optimal amount depends on your income, state tax rate, and projected balance at 73, but the principle is universal. Pay a small known tax now to avoid a large forced tax later. Step 5, give yourself permission to spend your money. I mean it. This is not just a tax strategy. This is a psychological intervention. You save this money to live on. You are alive. Live on it. Take the trip to Italy, fix the roof, buy the boat, help your grandchild with college. Every dollar you spend from your traditional IRA in your 60s at a 12% tax rate is a dollar. The IRS cannot force you to withdraw at 73 at 22%. Spending is not failure. Spending is a strategy. Step 6. If you are already 73 or older and the bomb has gone off, you can still do damage control. You cannot convert the RMD itself to Roth, but you can convert amounts above it. You can also use qualified charitable distributions under IRC Section 408. Deed to send up to $105,000 directly from your IRA to a qualifying charity in 2026. QCDs count towards your RMD, but are excluded from AGI. You satisfy the RMD, avoid the income tax, and keep your MAGI below IRMA thresholds. If you are charitably inclined, the QCD is the single most powerful tool in the retirement tax code. Step 7. Coordinate with your Social Security claiming decision. If you delay benefits to 70 to maximize your payment, You create a gap between 62 and 70 where your only income is IRA withdrawals. That gap is the strategic drawdown window. You use it aggressively. Fill low brackets with Roth conversions. By the time Social Security and RMDs begin, your traditional IRA should be small enough that the combined income stays out of the danger zone. Step 8. Hire a tax-aware financial planner, not a product salesman. Ask them, can you model my projected RMDs at 73, 75, 80, and 85, and show me how they interact with Social Security taxation and IRMA thresholds? If they cannot answer, leave. The advisor you need understands IRC Section 408, Publication 590B, the RMAA brackets, and the Social Security combined income formula. Anyone who does not understand all four is not qualified to manage a seven-figure tax-deferred retirement. Let me tell you what the financial media is not telling you. They celebrate the bull market. They profile retirees who became millionaires and call them success stories, but they never show you the back end. They never show you the IRMA letter from Social Security. They never show you the moment when a frugal couple opens their tax return and realizes the IRS is taking more enforced withdrawals than they voluntarily spent in an entire year. The silence is not accidental. The system benefits from your ignorance, and the institutions that manage your money get paid fees on a growing balance, which means they have a financial incentive to tell you to leave the money alone. Your advisor gets paid more when your IRA is bigger. The IRS collects more when your RMD is bigger. The only person who benefits from a smaller IRA is you. If you refuse to spend your own money in your 60s out of fear, the IRS will gladly spend it for you in your 70s through forced taxation. That is not a slogan. That is the arithmetic of the current tax code. Every year you delay withdrawing from your traditional IRA, you're compressing a decade of deferred taxes into a brutal mandatory window that opens on your 73rd birthday and never closes. Let me give you the final math. Diane and Gary's refusal to spend early cost them over $16,600 per year in excess federal taxes versus Richard and Susan. Over 15 years, that is $249,000 in excess federal tax. Add state taxes in Ohio and IRMA surcharges, and the lifetime cost of their frugality exceeds $350,000. They saved their way into a $350,000 tax penalty. You earned it. It is yours. Do not let the IRS decide how and when you use it.